Hello, everyone, and welcome to SCORE Fairfield County's webinar on tax items to consider before December 31, 2021. I'm Bob Hogan, the webinar coordinator today and a business mentor here at SCORE Fairfield County. I'm going to be your host today, and our presenter is Joe Dagestan. More on Joe in just a minute, but first some brief information on SCORE. SCORE is a nonprofit national partner of the SBA. And locally here at SCORE Fairfield County, we have about 100 volunteers with a wide range of industry process and subject matter expertise. And we offer 3 primary value-added services to small business owners, consisting of one-on-one counseling, and that is free to everyone. And if you want to take advantage of that, you can use the yellow bit.ly link on the screen, or you can go to our website and click on Request a Mentor. Secondly, we offer a wide range of educational workshops and webinars, roughly about 100 throughout the year, like the one today. And lastly, we offer extensive resources on our website. This webinar is a re-recording of the live webinar on November 16th, and it contains the accompanying PowerPoint slides, which unfortunately were not available during the live webinar. It's now my pleasure to introduce our speaker today, Joe Dagestan. Joe has over 40 years experience in accounting and taxes while working in public accounting, small business, and the IRS, where he retired in 2008 as a revenue agent. He also has been an adjunct at Fairfield University since 1972 and Manhattanville College since 2008. It's now my pleasure to turn it over to Joe. Joe, it's all yours.
Thank you, Bob. Welcome, everyone. I'm glad to be here. And the first order of business is to tell you that this is a tax presentation, not to be considered as tax advice. So if you want to make any decisions about your tax return for 2021, please speak to your tax preparer, CPA, before you make any decisions. Secondly, just an overview. Basically, we're talking about your 2021 1040, and the 1040, even though this is basically a small business type seminar and I am a mentor, your 1040 is a combination of your personal, your business, and your investment activity. So what that includes is not only your small business profit and loss, but if you have investments, interest income, dividend income. For older people, you may have pensions, Social Security, and for those 70 and a half that have traditional IRAs, we have to do required minimum distribution, which is income. So once you consolidate all those income and maybe some losses on your income, you'll come up with a figure called AGI, Adjusted Gross Income. Then from that, you have to make a decision. Do you want to take the standard deduction or the itemized deduction, which I'll comment on later? Once you determine that, that deduction is subtracted from AGI and you come up with taxable income. And then the taxable income is matched to 7 tax brackets, which range in a tax of 10% up to a high of 37%. And it all depends on your filing status. We'll cover that later. So this is the big picture of what we're going to talk about. I have about 20 plus slides, and each slide has a topic. And quickly, these are the topics, and not that you have to know them, but just to glance over them quickly, and then there'll be a slide on each one. We're going to review your 2020 tax return. We'll go over what the standard deductions are. There's some new rules on charity. We'll talk about pass-through business forms. We'll talk about, very important, if you have a profit in your business and it's a pass-through, you're going to be responsible for paying 15.3% on your profit. In addition to that, you also pay taxes, so it affects your cash flow. We'll talk about some rules on business losses, mention stimulus payments, which are not taxable. For those over 70 and a half, we'll briefly go over RMD, required minimum distribution, which is income on your return. If you have security gains or losses, which is Schedule D, we'll talk briefly about them. There's an annual gift exclusion for those that have extra money that they don't know what to do with. In case you've had a sale of a residence, we'll discuss that. Back to small business, there's something called Qualified Business Income, QBI, which is a new deduction in the last few years. We'll talk about the Connecticut Pet Tax, a complicated area, but we'll just mention on the surface is passive versus non-passive income. One of the tax items that we always promote is you want to defer income and you want to accelerate expenses. So one of the ways you may be able to defer income is on bonuses. And then where I received several questions, we're going to cover employee or independent contractor. And you can get an IRS conclusion as to whether the person that is going to do work for you is an employee or independent contractor by filing Form SS8 with the IRS, and they will make the decision. Also on the IRS, there's a 20-factor test on whether the person is an employee or independent contractor, and you answer the questions and they score. It's not an official decision conclusion, but it gives you an idea of which way the person should be treated. And then we'll briefly discuss what we do. My other volunteer aspect in the spring is preparing tax returns for free. We'll briefly go over that. Now, and the first thing you should do to get your mind thinking is review your 2020 federal tax return, federal and state. And what happened in 2020? Did you receive a refund or did you have to pay? Do you feel your income and deductions are going to be the same in 2021? If you received unemployment compensation in 2020, first 10,000 was not taxable. So if you received unemployment compensation in 2021, it's fully taxable. So that could increase your income 2020 versus 2021. And how much was withheld in 2021 versus 2020? Meet with your accountant, okay? And the business types that we're talking about, pass-throughs, they're a sub-S, a sole proprietor or an LLC, Schedule C, sub-S, partnership. They're all on your 1040. So on your business return, Schedule C, basically you're going to prepare and should have some indication of what the income and expenses are. So for your business return, there isn't any withholding like a W-2. So what you need to do in case you have to pay taxes, you have to go the estimated tax payment route, meaning you have to send in, it's a 1040 ES for the federal and the state if you want to pay the tax now, because the rule is when you actually do your 1040 tax return or your preparer, if you owe more than $1,000, either for federal or state, then there's a penalty. So even though you say you owe $5,000 and you pay it by April 15th, you're still going to be issued the calculation of the penalty, so you'll have to pay a little more. So that's why we suggest that you try to, if you owe money, make it less than $1,000. If you have a refund, that's fine. Unfortunately, you don't get any interest on the refund. Now, the standard deductions for a single person, they're $12,550. Married filing joint, $25,001. Married filing separately, head of household, $18,800. So this is the standard deduction. So look at your 2020 return. If you took the standard deduction, you'll see that for 2021, they've probably gone up by a couple of $100. If you itemize, that means health expenses, Connecticut withholding, property tax if you own a house, interest, and charity would exceed this. Most preparers will ask you about the information. They'll put the information in. If your itemized deductions do not exceed these standard, then the computer will automatically select the standard. This came about a couple of years ago by our friend, former President Trump. And also what he did, the taxable income brackets range from 10% to 37% for individuals. If you're single, married filing joint, married filing separate, head of household. But what Trump also did for corporations, 1120C, their tax rate was 35%. It's gone down to 21%, a significant decrease. And you see the last line on this slide, if you're married filing joint and you're both over 65, then your standard deduction is up to $27,800. Now, the charitable deduction. If you take the standard deduction, any contributions you made to charity and whatnot are automatically included in the standard deduction. So you don't get an extra deduction for that. So what the House of Representatives and Congress did, they said, if you're taking the standard deduction and you did make cash, the word is cash, not property, cash contributions like to a church or synagogue or any nonprofit, then you can take $300 deduction if you're single and $600 if you're married filing joint. If you made, $300 or $600 or more, that's a deduction before adjusted gross income. Now, if you need help on keeping your books for your business, there's a free website that I prepared, and there's the link, bum14bklyn.simplesite, and it walks you through how to do accounting and bookkeeping. Now, you have to remember for yourself, friends, and relatives, if you are to receive a federal or state refund, it doesn't happen automatically. You must file a tax return, even if you have no taxable income. Case in point, let's say you have a teenager that works during the summer and makes $1,200. There's no taxable income there. If whoever they worked for did withhold federal or state refund, then you have to file a tax return for that person to get the refund. Same goes for senior citizens. So the IRS really urges everyone to file a tax return. One of the reasons is that identity theft is a big problem. So by filing a tax return, even if there is no refund or amount due, then you'll find out that someone did not steal your tax ID. And that's one of the ways that the IRS is attacking this problem. Okay, next, pass-through entities. Most, if not all of your businesses that we're talking about are pass-through entities, meaning you're gonna have to report them somewhere on your 1040. The only pass-through entity that is not reported on your 1040 is if you are an 1120C corporation. That means you're going to file a corporation return in addition to your 1040, and the income or loss on the 1120C, the corporation, is separate. Okay, so what are the pass-through entities? If you're a sole proprietor, you open up business, your income statement basically goes on Schedule C. If you're an LLC single member, your income statement also goes on as Schedule C. Now, if you're a partnership, I mean, you could be an LLC partnership, but the partnership must file a 1065. It's not a taxable form. Attached to the 1065 is a K-1 for each partner. The K1 is the document that goes on the partner's 1040 Schedule E, profit or losses. Sub S must file a 1120S, it's non-taxable, and a K1 is also issued to each owner, and that goes on the 1040 Schedule E. If you're a landlord, then your rental income and expenses are reported Schedule E, page 1. And again, a C Corp is not a pass-through, and the tax rate is 21%. Losses stay there, okay? Losses can't go anywhere else. Let's see, this is a little repetition. There's really nothing new here. So we'll just go through this. It's basically a duplicate of the prior slide. Now, the big item for small business, the 15.3% self-employment tax, referred to SE, on pass-through business forms. Now let's just step back once. If you're an employee, you're being issued a W-2. Every time you get your paycheck, there is a deduction for Social Security and for Medicare. That's what we refer to as the SE. If you are an employee, that amounts to 7.65% of your gross, okay? Now, the employer also has to send 7.65 for you to the government for Social Security and for Medicare. So that's how we come up with the 15.3%. Now, if you're a pass-through in a small business and you have a profit, you pay the 15.3%, okay, to the government. And basically, you don't have a choice then. Now, it's only on the profit. So if your business has a loss, you're not subject to the 15.3%. And because as a small business person, you're basically wear two hats. You're the employee and the employer. That's why you pay the 15.3%. Now, the only little gizmo in this area is the sub S does not have to pay SE tax on profits as long as the owners are paid reasonable salary. So the sub S basically can hire the owners as a W-2 employee, and if there's a profit, they don't pay SE tax. But don't forget, the sub S has paid the equivalent 15.3% on the W-2 to the owners, whose W-2 will go to their 1040. So just a little wrinkle as to the way the SE tax is actually paid. So a quick example, if you had a $100,000 profit in your business, you have to pay $15,300 on your SE tax. And let's say your tax bracket is about 20, then there's another 20,000 tax. So you have tax of 35,300 plus state tax. So in Connecticut, it's about 6%. So what happens is that there's no withholding. So for you to pay that tax as you're going along, you have to do 1040E estimated for federal and for tax. And the recommended estimated tax our dates are 4. There's 4/15, 6/15, 9/15, and 1/18/2022. Now, those are the recommended. If let's say you didn't pay any estimated tax up to this point, and because of this little presentation, you realize you're going to owe tax. Well, the federal government, the IRS, and the state, they will accept payments all the time. They like to do it quarterly. It's convenient, but it's not required. I have a couple of people that basically the first half of the year, the business is losing money. So they don't really pay their quarterly tax until 9/15 and 1/18. The important thing is to pay it because there's no withholding, so you don't get over that 1,000 limit and have to pay a penalty. Now, the good news is if you're profitable and your profit is more than 142,800 in 2021, there is no Social Security tax. But there is a tax on Medicare, which is about 2.9%. There's no limit. The 142,800 only applies to Social Security. And that increases each year due to inflation. As an example, in 2020, the Social Security limit was 137,700 and went up to 142,800, as I just mentioned. The tax brackets, which you can find on the irs.gov site, range from, there's 7 of them, 10%, 12%, 22%, 24%, 32%, 35%, 37%. They're all income sensitive. Just a quick example to let you know how the tax brackets work. And again, they're on the irs.gov site. The married filing joint, they go into the 22% bracket if their income exceeds 81,000 to 172,000. So the amount of money before 81,000 is taxed at 10 and 12%. Now, if you're single and you're in the 22% bracket, that income range is 40,000 to 86,000. So single people pay higher taxes than married filing joint. And you'll see the brackets again on irs.gov. Now, business losses. Basically, if there's a loss in your business, yes, it goes on your 1040. The only exception is, well, there's 2. If it's a 1120C business, the loss stays on the 1120C. It doesn't go on your 1040. If it's in general, the loss on your business is going to offset other income on your return and actually reduce adjusted gross income and taxable income. The only little wrinkle in this is that partners are limited to what losses they should take. So each partner has to keep track of their investment in the business and what is called their capital account. So when they get the K1, if there's a loss, the capital account has to be positive, has to exceed the loss. And how does the capital account managed? Basically, it starts with what did you invest in the partnership? So that means you have a capital investment. Secondly, over the years of the partnership, were there profits? So that's add to capital. If there are losses, then they reduce capital. And if the partner withdrew money, that would reduce capital. So they have to keep a running scale from day one of the partnership to forever to make sure that their capital account has enough money. The capital account is called basis, so they can take a loss. Sub-S losses are just like the what we said in the partner too. Rental losses have a little quirk in that they're limited. So you do the Schedule E, page 1 for your rental property, and if there's a loss, it's limited to 25,000. If your adjusted gross income is below 100,000. So this is called passive income and losses. And basically, you are not able to take losses exceeding 25,000. Now, the losses over 25,000 sort of go into a hopper. So when you actually sell your rental property, you'll pick up that loss. So you cannot take them currently, but down the road you can. Now, a simple item here, stimulus payments. Many people have been receiving stimulus payments. They are all non-taxable, okay? So don't worry about them. We may even be up to a 4th stimulus payment, I'm not sure. Now, another reminder, unemployment compensation is 100% taxable in 2021. You did receive a $10,200 deduction in 2020. That no longer exists. In 2021, if you're taking a deduction for your automobile business miles, it's up to 56 cents a mile. Business meals, continue to be 100% deductible. A few years ago, they were only 50%. Now, resources to keep heads up on current tax changes or small business tips. The IRS has a free site. You go to irs.gov, you put your email in, IRS tax tips, and you'll get a tax tip each day. You can review it. If you think it's useful, save it on your computer. If not, you just delete it. Another one is Big Ideas for Small Business. That's by Barbara Weltman, who gave a presentation like I'm giving a few weeks ago. And she's from Vero Beach, Florida. And she comes out with a daily blog, Big Ideas for Small Business. And she's written several books also. Again, that comes out daily. Once you go to Big Ideas for Small Business, you give her the email and she'll send you a daily blog. Again, it's a lot about employee and business expenses. So it is very useful to small business. Next, we'll briefly go over, for those who are over 70 and a half, like me, we have to do an RMD contribution each year because when we were working, we had an IRA or 401k or 403b, and we didn't pay tax on this money. And hopefully over the years, it also, the dividends and the interest, and if we made money on the particular investment, that was non-taxable. And the RMD contributions that we have to withdraw each year are taxable income on our 1040 and increase the adjusted gross income. So the rule is if you're over 70 and a half, you're subject to this. The rule just changed. So after 12/31/2019, the age went up to 72. Okay. There's a formula. Basically, the formula starts with what's the market value of your traditional IRA 401k as of 12/31 in the year. So, and so you get the market value, let's say as of 12/31/20, then you calculate what the RMD is, and you must withdraw the amount before 12/31/21. If you don't, there's a 50% penalty in addition to withdrawing the amount and paying the tax. So the good news is that the financial institution that holds your traditional IRA or whatnot, they will send you a letter each January, I think. I think it's Form 5498. I'm not positive of the number, but, and that will calculate the RMD for you. And the bank, as a service, they will ask you, do you want us to withdraw it for you, and how do you want it? So you may want it quarterly, annually, or one payment. And once you sign up with them, they could say, if you want this permanent, then, for example, you know, we'll calculate it, and every June we'll send you the RMD. So you won't fail and be subject to the 50% penalty. Now, the other new item that came up a few years ago is, remember we said that if you take the standard deduction, you're only going to get $300 deduction for charity or $600 married filing joint. Well, one little wrinkle in the tax law here is from your RMD, you can write checks from your RMD for your charity. Those withdrawals to the nonprofit count as far as your RMD. And you could make up to, for the rich and famous, up to $100,000 per year to a charity. The beauty of it is those amounts that you send to charity count towards your RMD, but is not taxable. So if your RMD was, say, $20,000, and let's say you gave $5,000 to charity, you did withdraw $20,000, but since $5,000 was charity, only $15,000 will be taxable on your 1040. If you didn't make anything to charity and you withdrew the 20, the whole 20 would be taxable. So a very quick example on the RMD. Let's say the market value of your account, when you look at it on 12/31/21, is 180,000. The IRS factor, which is at irs.gov, the RMD factor is, let's say your age is 78, so the factor is 20.3. So you divide the 180,000 by 20.3, your RMD amount is almost $9,000. That's what you have to withdraw by 12/31/22. The beauty of this is that in general, as you get older, the factors are gonna, make you withdraw more, but basically it's not more than 4 to 6%. That's what happens. So if you pass away and there's something in there, your beneficiary will get the remainder, okay, and be able to withdraw also. Okay, I think we covered that. Security losses, that goes on Schedule D. So if you're now, if you're trading in your traditional IRA, there are no taxable security gains and losses, so you don't have to worry about it. We're talking about regular accounts. In addition to your business, you have an account with Merrill Lynch or UBS or something like that, and you're trading. So if you own the security, mutual funds, stocks, or bonds for less than a year, it's called short-term gain or loss, and it's ordinary income. If you own it for more than that, it's a capital gain, and depending upon your income, it's taxed at either 15 or 20%. Now, you have to realize that losses net against gains. If, like in my case, 1 year, all I had was capital gains. So the only thing, the maximum capital loss you can take any 1 year is 3,000. And then the excess over that goes to next year. You don't lose it, it just gets postponed. And in order for me to take the excess next year, I had to sell stock with a gain to take advantage of that loss. If you don't have any capital gains in the future years, you're not going to be able to take the loss. But in addition to securities, if you sell your house, that may be a capital gain, so that could utilize the loss too. And if you have a significant gain, you can ask the financial institution to take out withholding, so you don't have to make an estimated tax and get a big surprise when you do your return that you forgot you sold the security as a big gain, and you have to pay tax on it. And then one little wrinkle: some people sell the security at a loss; they want to get rid of it, but they like it and they think it's going to go up in the future, but they want to take the loss. They have a lot of gains. You can buy back the security, but it has to be after 30 days. If you bought the security back before that, it's a wash sale and you don't get the benefit of the loss. So your financial advisor should advise you of that. Whenever you do any security buys and sells, before you do that, you should be aware of what the gain or loss is going to be. And the financial institution should have that information available. If you get a monthly statement, that information is available. It's called unrealized gains or losses. It's on your financial statement every year by security. Now, if for the rich and famous, if you have a slush fund and you don't know what to do with the money, basically you have an annual exclusion for gifts, $15,000 per person, to anyone, doesn't have to be a relative. In addition to that, if you're married filing joint, it's not 15, it's 30,000. So you can give away to anyone, let's say you're married filing joint, 30,000. It's not income to the receiver and it's not a deduction for you. Just a way of passing along money that you feel needy people could use. If you exceed the limit, you have to file a tax form, but you're not going to pay tax on what this is called estate tax exemption unless the amount you give away is more than 11,700,000. And the estate tax exemption for the state Connecticut is 7,000,001. It will mirror the federal in 2023. So when you pass away, your executor will file a 1040 for you, and then they will value all your estate, your house, your investments, etc. And if it doesn't equal more than 11,700,000, they don't have to file an estate tax. That's the exemption. And I was at a seminar one day, and in the front row were some wealthy people. They live on Fifth Avenue and whatnot, and they were amazed at this. They said, I have 3 children and 7 grandchildren. That's 10. I could give each of them $300,000 a year, and that would be great for them. They could use it to buy a house or education or whatnot. So they never knew about this, and of course, again, the exclusion doesn't. It's up to $15,000 per person. So if you want to give, grandchildren, niece, nephew, $3,000 or $4,000, it's not taxable to them, and you didn't exceed the $15,000. So it's basically what we call a freebie. Now another benefit in a different area: sale of a residence. If you sell your residence and you're single, the first $250,000 of profit is forgiven. If you're married filing joint, the first $500,000 of profit is forgiven. Losses on the sale of a residence you're not able to take a loss anywhere. It's not deductible. Many people move here and there. During their lifetime, they've had multiple residences. As long as you've lived in that residence for 2 years, you can use this 250, 500 multiple times. It's not restricted. And what you have to keep track of to find out what the gain is the cost or basis of your residence. So that's the purchase price plus any additions like a new roof, heating system, windows, doors, gutters, driveway, etc. So the gain on the house is the selling price, and one of the costs is real estate commission, less all the costs we mentioned above. And this is reported on Schedule D. So even if your gain did not exceed, say, $250, you have to report it on Schedule D. And Schedule D, you have to show the gain. Let's say the gain on the residence was $200,000. Then there's another box where you take the exemption of $250. So on the Schedule D, there's no gain, but you have to show that. The reason is that the real estate agent reported the sale to the IRS. So the IRS is looking for you to report the sale on your tax return. They don't know whether there's a gain that is going to be taxable. So that's why it has to be reported. Next is what we call QBI, Qualified Business Income Deduction. This was brought about because Congress reduced the corporate rate materially from 35% to 21%. They didn't do anything to the small business 1040 type person. So what they recommended and what is in practice is a qualified business income deduction. It can be as high as 20%. It's a deduction. It's only on the profit of your business. And it doesn't reduce SE tax or anything. It's just a calculation for a deduction. So it reduces adjusted gross income. It's a complicated formula. It's on the tax return, it's Form 8995. Most practitioners use software, so the software will calculate this. And again, it can be as high as 20%, but often because of the calculation and what they consider may be less. And again, it's a deduction. And of course, the deduction is limited based on income. So your income can't be above $164,900. If you're single income, what they usually mean is your adjusted gross income, not taxable. And if you're married filing joint, your income can't be above $329,800. All right, and the deduction will appear on page 1040, page 1, line 13. It reduces taxable income and adjusted gross income, I believe. The Connecticut Pet Tax. Briefly, because Trump passed a law in several years ago, if you itemize your deductions, you used to be able to deduct all your property tax and all your withholding to Connecticut. What he did, and it was catastrophic, it affected a lot of people, including me, he limited that itemized deduction to $10,000. Well, many people, especially in Fairfield County, own houses, their property taxes alone exceed $10,000. And of course, they do Connecticut withholding. So this was a shock. We didn't have anything. So this little wrinkle here, this pet tax, Connecticut allows your business to make a contribution, and then it gets to be a deduction, okay, on your Connecticut income tax return. So it doesn't make up for the 10,000 limit, but it gives back something. Again, it's your accountant will know about this and recommend it, and it will be on your Connecticut return. Passive and non-passive income. This is a highly complicated area. You will only be subject to this if you have investments. If you're leasing, if you have rental property or limited partnerships, which are usually in mutual funds. You will get a K1 and it will go on your 1040. If there is a loss, and it will show you on the K1, it will show you that this loss is non-passive. So what that means is that you cannot take the loss unless you have K1s with a gain. Passive losses can only offset passive gains. If you only have passive gains, you report them on your 1040. An activity to be passive, the participant doesn't materially participate. So I have a limited partnership. I get a K1. My ownership is about 0.00010, very small. I don't materially participate. Fortunately, the one I have always has small gains. I haven't had any loss. If it had a loss, I don't have any other limited partnerships. I wouldn't be able to take it until the partnership had a gain, then I can. And it is another rule as to what materially participate. Now we said rental property, so that's the Schedule E, page 1, where we said there's a 25,000 limit on it based on income. So that's being a landlord is considered passive property. Bonus. We're doing pretty good on time. I'll go through the next few and then we'll answer some questions. In Wall Street, if you were a W-2 and you were awarded a bonus, what they normally did, the Wall Street firm, say you're getting a bonus for 2021, they would calculate it in December and they'll pay you in 2022. And the reason is there's a wrinkle in the tax code that says they're on the accrual accounting system, not the cash. So they get the deduction in 2021, even though they didn't pay you. When they paid you in 2022, to get the deduction, they have to pay you in the first 2.5 months of 2022. And then you get the bonus, say in January 2022, you don't have to pay taxes on that until the tax season when your tax return is due in 2023. So it's a little delay there. In the small business area, most people are on a cash basis, so this isn't going to apply. But to get your money out of the system, you make withdrawals. So if you have a good year, you're going to pay tax on the income statement. So even if you withdraw it whatever year, it doesn't enter into this system, this bonus. Your withdrawal from your LLC or partnership is not taxable, and we'll discuss that a little bit. I see here that was one of the questions they wanted us to discuss. Now, employee versus independent contractor. If you're about to hire someone, and the first thing you do when you hire someone, you always get a copy of their Social Security card. That's number one. And of course, maybe a copy of their driver's license and residence. Now, if you're not sure, you can send a form into the IRS called SS8, and they will determine whether the person you're going to hire is to be treated as an employee, where you'll give them a W-2, you'll collect Social Security, that's 7.65, and Medicare, and you'll pay 7.65. Or if they're an independent contractor, you pay them, you don't deduct anything, you give them a 1099 at the end of the year. In both situations, these people are deductible as wages on your business return. So some of the factors that, determine the person is an employee. You're controlling them. They receive benefits, vacation, holiday, sick time, 401k. So there's no doubt that that person's going to be an employee. A lot of small businesses, they start out alone. They need more help. And once you hire an employee, there's an expense and a lot of paperwork. So what happens is if you hire an employee, you have to match the 7.65%. For state purposes, you have to pay unemployment insurance, and you're probably going to have to pay workman's compensation insurance. So if you hire the person for $30,000, these extra items that you're actually paying the person maybe more like $40,000. You have to realize that. So some people who are needing more help, what they'll do is they'll say, I need a person for a limited period of time for a project. What they'll do, they'll hire a person this way, and that person basically does the project independently. And you should have a written agreement, and this person will be considered an independent contractor. And then you inspect the work and pay the final amounts due when the work is done. If the work isn't done satisfactorily, then you have an argument, and then if there's a lawsuit, hopefully you're an LLC and whatnot, so that you're not subject to being sued for your personal assets like your non-LLC bank accounts and your personal residence. You can go to the irs.gov site if you don't want to file SS8, and there's a 20-factor test. It's not absolute, but in answering the questions and scoring, it gives you an idea of whether this person you're about to hire is a independent contractor or an employee. Some minorities don't even know how they're treated, and they don't raise the question, and some small business or even large business employees abuse the privilege. They treat them as an IC. It should be an employee. If they're not audited, then it goes on. If they get audited and the IRS determines the IC is an employee, then the employer pays some penalties for that. I mentioned one of the other things I do is I volunteer for VITA. We do tax returns for free. It's a partnership with the IRS. We have various locations, Norwalk Library, Darien Library, Fairfield. It's a national program. 2020 returns were mostly done virtually. Hopefully in 2022, when we do the 2021, we'll be back to face-to-face. The program is meant for medium and low income people. And basically, we don't do any returns that have depreciation. We don't do Schedule C business expenses over 35,000. We don't handle cancellation of debt, home office, or we don't do rental property. So it's mainly a lot of people that take the standard deduction, married filing joints, single parents, and you know, we aim to please. If you're interested in having your return done, during the tax season starting in January, you Google VITA, V-I-T-A, put in your zip code, they'll give you the nearest location. And you can always bring in last year's return and let the preparer look at it to see if you come within the definition of a return that we can do for VITA. It's done online. You get a copy printout of your federal and state. On site, it's double checked. And if you do a refund, we suggest direct deposit, and your federal and state refunds will probably be in your bank account within 2 weeks. For the IRS, they reduced the paper load, okay? And it's a good system. All right, so that ends it. There's a few questions that were asked. One had to do with independent contractor. When do I have to send the 1099? You know, when you send the 1099 or the W-2, a copy goes to the IRS and a copy goes to the particular individual. For independent contractor, it's $600, exceeds $600 a year per person. That's the one you have to send the 1099. If you're not sure, you know, calculate it. If it's $450, you're not going to violate anything by sending in a 1099 to the IRS and to the employee. The IRS then makes sure that that 1099 is reported on the particular person's 1040. Another question was, what if I have a person who, let's say, lives in Canada and he's working for me? Well, you can never lose anything by giving the person a 1099, assuming the person gave you his Social Security. So you've done your obligation, and then he has his obligation of how he's going to file his Canadian tax return, and if he's obligated to file the US tax return. Another question had to do with, let me see, I thought it was independent contractors. Let me just see. No, I think I covered them. Those were the two main questions. Well, another question that came up was a husband and wife. They're in different businesses. Yes, you should file 2 Schedule Cs on your tax return. Assuming both are LLCs, which we recommended, then you have 2 separate LLCs, 2 separate Schedule Cs on your 1040 tax return. And of course, they have 2 separate income statements. So that about does it. If perchance you have a question and weren't able to have it answered here, you do have my email, which is all lowercase, joseph.dagestan@scorevolunteer.org, and send it in. And I'm a mentor too, so we could hopefully handle your situation over the phone or face-to-face if needed. Thanks for your attention, and good luck with your taxes.
Good. Thanks, Joe. This concludes the recording of our webinar today. And again, just a reminder, if you would like to take advantage of free mentoring, you can get a SCORE mentor by using the yellow bit.ly link on the screen, or you can go to our website down there, fairfieldcounty.score.org, and click on the request a mentor link. And in closing, I'd like to really thank Joe for a very highly informative webinar today. And stay well, everyone. And thank you for watching the recording.
And happy Thanksgiving. Thank you.